Good evening, students. Welcome to this class. Today we are going to discuss about the basic concepts, the tax rate on under the Income Tax Act, and basic terminologies. How do you understand the Income Tax Act? The interpretation. How do you have to make? All that we are going to refer in today's lecture. So let's quickly begin with today's class. I'll share the screen. Yes. Yes. So, first of all, let's talk about where the power to tax comes from. So, anything or any tax can be raised or levied only through the power granted under the Indian Constitution. So, other than that, you cannot raise or levy any taxes. Power to tax the income comes from Article 265, which says that this Article 265 expressly says that no tax shall be levied or collected except by the authority of law. So, unless and until there is a power to tax granted under the Constitution, the tax cannot be levied. Now, from where does the income tax comes from? Income tax is there, the taxes on income is covered under entry 82 of list 1 in the 7th schedule to article 246. This particular entry grants the power to tax the income. Now, very important, there are three lists as you might be knowing. The first is the union list, the second is the state list, and the third list is the concurrent list, under which there are subjects where both state and union can legislate. Now, tax on income falls within the power of center. The state cannot levy taxes on income. The state can levy taxes on only agricultural income. And hence, you might be knowing agricultural income is exempted from income tax. So, that is the reason why tax on income is covered under entry 82, and this is particularly excluded the agricultural income from the Income Tax Act. Now, one very important distinction which is to be understood is between the direct and indirect taxes. Can you tell me what is the very important distinction factor between the direct and indirect tax? So, income tax is a direct tax, right? And GST or VATs, excise, service tax are indirect taxes. What is the important distinguishing factor between the two? Can you quickly write in your chat boxes? What do you think is the distinction between a direct and an indirect tax? I wish to know answers from you. What do you think? How would you distinguish whether a tax is a direct in nature versus a tax which is indirect in nature? Any answers quickly? What do you think? Please give me the answers in your chat boxes. Yes, Neil. Your answer is correct. What else can be the distinguishing point? Yes, Kunal. Leela, that is a correct answer. But I need more explanation. What do you think? Please give me the answers in your chat boxes. What do you think is the difference between direct and an indirect tax? Okay, so I've got only very few answers. But let me tell you, under direct tax, you need to ask a question. Who is earning an income? Right? Because direct tax is on the person. It is on the income which is earned by a person. Right? And whereas this indirect tax, you need to ask the question where the income is being earned. So under direct tax, you need to ask a question who is earning the income, whereas under indirect tax, you need to ask where is the income where the goods are being sold or the services are being provided. Why? Because indirect tax is consumption based tax. Indirect taxes are generally consumption based destination taxes. They are imposed where the goods are being consumed. So if you see on exports, we do not charge any GST. The reason is it will be charged in the country where they are consumed. It's a consumption based destination tax. Whereas in imports, we charge it, right? Because these goods are consumed in India or the services are rendered or provided in India. That is a very important distinction between direct and indirect tax. However, when from the domestic tax, you move towards international taxation, there you need to ask again both the questions. Where it is being earned and who is earning it. Where it is being earned and who is earning that income when you are doing international tax. Why? Because under international tax, where also it becomes important question, because that will be the country which will also have the right to tax, right? But while we are doing domestic tax, you need to understand the difference between domestic and indirect taxes. Direct tax is on the person who is earning, and indirect tax is on the particular goods or services. It can be passed on to the consumer. Direct tax cannot be passed on, right? But then if you notice, we have done or you have been taught equalization levy, right? Your lecture has already been taken up on equalization levy. So what do you think is the nature of equalization levy? Whether it's a direct tax or whether it's an indirect tax. What do you think? What are your answers? Tell me in your chat boxes. What do you think about equalization levy? Your lecture has already been taken up on that. What do you think? Whether equalization levy is the tax? Give me your answers in the chat boxes. What do you think about equalization levy? Okay, Neil, your answer is correct. But then, Neil, don't you think it is being passed on to the consumer also? In that case, what do you think? What are the other answers for equalization levy? Please give me answer in your chat boxes. Quickly. Ambika, why do you say so? What is your reason for that? Muthu, why do you say? Give me the reasons also. Yes, Neil. Sumit, yes. So see, there are two sides of the argument to the equalization levy. Some call it as a burden being passed on to the consumer. So it is in the nature of indirect taxation, right? But I would say that equalization levy is a direct tax. It is coming through the Finance Act, right? And first of all, if you see, it is not an income tax. It's not an income tax. It's a separate levy coming through Finance Act. Now the question is, if it is coming through Finance Act, whether it's a direct or indirect in nature, that's the question being asked. So some people contend that it's an indirect tax because it is just like VAT or GST, where the burden is ultimately being passed on to the consumer. That was true with regard to equalization levy on advertisements. There is a new equalization levy which would have been taught to you, which is on the non-resident e-commerce operator, right? Which is on the non-resident e-commerce operator himself. So that is something in the nature of a direct tax. That is something in the nature of direct tax that he cannot pass on the burden directly. Also, he may try to pass on the burden, but who is ultimately liable? The e-commerce operator who is earning the income. Under the advertisements, the first equalization levy which had come up, there the payer was obligated to deduct equalization levy just like TDS. But here, the e-commerce operator himself has to pay that. Also, why equalization levy is being imposed? Because income tax is not possible in the absence of permanent establishment. And that is the rationale of introducing equalization levy. So what equalization levy is trying to do is, it is trying to substitute the income tax. Therefore, one can say it's a direct in nature. But there is again a counter argument to that also. If you would have been taught that equalization levy is not covered by the DTAAs, and DTAAs only cover taxes on income, so then why equalization levy is kept outside? That could be a counter argument to say that it's in the nature of indirect tax. So there are both sides of argument. The committee report, which was there on equalization levy, that said that it is in the nature of direct tax. But there is no final verdict of a court to conclude whether it is a direct or indirect. It has the characteristics of both. Are you getting that? So that is a kind of ambiguity which exists under equalization levy. Now going further, first of all, we step into the charging section. For creating any charge on the subject, first we need to refer to the charging section always, right, under any act. So from where does this charge gets created? The charge gets created through section 4 of Income Tax Act. Now, besides this section 4, there is also the general charging sections under each head of income. And then there are specific charging sections also under each head of income. So section 4 is the general charging section. Besides that, to classify the income under separate heads of income, there are separate charging sections. Just hold on for a moment. I'll make a note of this. I'll give you the notes for this. Okay. So see, there is this charging section 4, which is the general charge for charging the tax on income. Once you fall under the charging section, then you go to the specific heads of income. So before we go that, let's understand what this section 4 says. Section 4 says, where any central act enacts that income tax shall be charged for any assessment year at any rate or rates, income tax at that rate or those rates shall be charged for that year in accordance with and subject to the provisions, including provisions for the levy of additional income tax of this act in respect of the total income of a previous year of every person. Now, this seems very complex. Let's try to break it down. So, where any central act enacts that income tax shall be charged at rates, income tax shall be charged at rates for any assessment year on total income of a person, on total income of the previous year of every person. Let's write like that. Total income of previous year of every person. Now, I have just brought in the crux of the definition. First is the central act. Second is the assessment year. Third is the total income. Fourth is the previous year. And fifth is the person. Now we look into these things. So this section 4 creates a charge on the total income. On the total income, right? total income of previous year of every person. Now, what is total income? What is total income? Total income is defined under section 245. Total income is defined under section 245. Right? And even the term person is defined. But first we look into the definition of total income. How is total income defined under 245? 245 says that total income means one second. Total amount of income referred to in section 5 and computed in manner laid down under this act. Right? So total income is defined under section 245, which means total amount of income referred to in section 5 and computed in the manner laid down under this act. Now, what is the manner laid down under this act? That means your heads of income. And what is section 5? Section 5 we have already covered in the international tax class, the scope of total income. For resident, global income is liable to be taxed. For non-resident, only the Indian sourced income. For RNOR also only the Indian sourced income. Right? So, total income means total amount of income referred to in section 5 for different categories of person and computed as per the manner laid down under this act. Right? Now, if you see, income is defined under section 224. Income is defined under section 224 in an inclusive manner. Right? And the computation mechanism is given. From section 14 to section 56. I'm just considering the heads of income. Right? Now, if you see separately, salaries are covered under section 14. There is a charging section to that. There is a charging section under section 22 for income from house property. There is section 28 which covers PGBP, right? Section 45 which covers chargeability under the head capital gain, and section 56 for income from other sources. Again, all these are general charges. There are certain specific charges also which are created under the separate head. So where the income might not have been considered as income, or the particular receipt might not have been considered as income, but it is deemed to be considered as income if it is chargeable under a specific charge. For example, what could be the specific example for that? Say, for example, under the head of capital gains, which we'll see in the coming classes, and there are specific charges created where, say, an asset is destroyed, right? At that time, the compensation which is received is considered. There are specific charges under section 28 also. For example, for non-compete fees, which are specifically created, though they might be of the capital nature, right? So then there are general charges and then there are specific charges also. Is it clear? Now coming to the definition of person. Who is included in the definition of person? Let's look together. Person. Person includes an individual, a Hindu undivided family, company, firm, association of persons, body of individuals, whether incorporated or not, a local authority, and every artificial juridical person not falling within any of the preceding subclauses. Trust is not a person, right? So trust is not considered as a person. So trust income would be taxable in the hands of beneficiary or the trustees, right? So that is why the definition of person is also very important to understand. Now, if you see, we have covered the total income, we have covered person. Total income earned in the previous year, our previous year is April to March, would be charged in the next assessment year. Now, the rates are coming from where? It says where any central act enacts. Now, what is a central act? Central Act means the Finance Act. Central Act means the Finance Act. So, this means the Finance Act. So, the rates usually come through the Finance Act, and to the Finance Act there is Part 1, Part 2 and Part 3. Part 1 gives the rate for the last year. Part 1 gives the rates for the last year. Part 2 gives the rates for the current year. Part 2 gives the rate of the TDS for the current year, and Part 3 gives the rate for the advanced taxes. And then next year again the Part 3 will become Part 1 of the next Finance Act. Clear? Now the rates are given under this, under the schedule to the Finance Act. And then there are parts to that. Other than that, there are certain special rates also under the Income Tax Act. For example, while we were doing international tax class, we had covered some special rates under 115. Do you remember? So those are the rates prescribed under the Income Tax Act itself. Those are not coming through Finance Act. So those rates would apply where there is a specific rate mentioned under the Income Tax Act itself. Is it clear? So do you understand how do we go into the charging section and how is the charge created? Any doubts with respect to this? Any questions or any doubts? No, Padmaban. Trust does not come under AOP or BOI. It is not in the nature of AOP. It's not association of person. It's a trust which is created by a settler. A trustee is appointed and the income is distributed to beneficiaries. It is different from association of person or body of individual. Unless it is registered as AOP or BOI, then the question becomes different. Any doubts? Sumit, I have not come upon that. I'll come in meantime. I'll explain you that, Sumit. Yes, Neil, I'll explain again the general charge and the specific charge. So general charge is the one which is generally there for creating a charge under different heads of income. So before you go to a different head of income, you get into that charge. So there is a charge of section 28 which makes you enter under the head business or profession. There are also specific charge section under 28 itself, where an income might be of a capital nature, where it might be of a capital as a revenue in nature because of that specific charging section. So non-compete fee is usually of a capital nature, but it is treated as revenue because there is a specific charge under section 28. So that is the difference between a general and a specific charge. Clear, Neil? Any other doubt? Did you understand, Neil? Okay. So should we proceed further? If there are no further doubts. Okay. So now we go to the next part of it, the tax rates. As I said, rates of income tax are coming through the Finance Act. First, I am talking about individual or HUF or AOP, BOI, artificial juridical person. For person below 60 years, a resident or non-resident, for them, tax rates are up to 2.5 lakhs, it is exempt. 2.5 to 5 lakhs, it's 5%. 5 to 10 lakhs, it is 20%. And 10 lakhs and above, it's 30%. For person above 60 years but below 80 years of age, up to 3 lakhs, exempt. 3 lakh to 5 lakhs, 5%. 5 to 10, 20%. 10 and above, 30%. And for person above 80 years, up to 5 lakhs, it's exempt. 5 to 10, it's 20. And 10 and above, it is 30. Now, there is one important distinction between them. The first category is for resident and non-resident both. But the second category is only for the resident, second and third. So if, say for example, the person is a non-resident aged 65 years, he will not get the higher limit of 3 and 5 lakhs. To be precisely 3 lakh. So he would fall under the first category only. For non-resident, the higher slab rates are not available. The higher slab rates are not available. Okay. So for a person who is a non-resident aged 65 years or 85 years, for them, this particular category of higher slab rate is not available. Is it clear? Now, going further, there is this new optional personal tax regime which has been introduced. There is new optional personal tax regime which has been introduced. What is that? This is an optional regime. This is not a compulsory regime. So this was there till the last year. This will be there in the current year also, but a new regime of lower taxes has been introduced for assessees, but it is a condition-based optional tax regime. What are the slab rates? First look into it. It is for all age of person, whether 60, 80 or 50, whatever is the age, it is for all aged person and for all resident as well as non-resident individual. So up to rupees 2.5 lakh, it will be exempt. From 2.5 to 5 lakh, it will be 5%. 5 to 7.5 lakh, 10%. 7.5 to 10 lakh 15%, 10 to 12.5 20%, 12.5 to 15 25%, 15 lakh and above 30%. So now an assessee can choose between the two tax rates and which one he wants to opt into. This optional personal tax regime is given under section 115 BAC, right? And this is coming through the Finance Act. Both the assessee can choose from both the scheme which one is beneficial to them. So before we go into the optional personal tax regime, I have to ask you one question. Say for example, if a person is becoming 60 years on 31st March 2020, on 1st April 2020, right? If a person is becoming of the age of 60 years on 1st April 2020, will he get the higher limit of rupees 3 lakhs in the previous year, 1920? What do you think is the answer? He will become of 60 years in the first day of April of 2020. Now, the question arises, will he get the higher limit of rupees 3 lakh on the 31st March 2020 for the previous year 1920? That is my question to you. What is the answer? Reply me in your chat boxes. Kunal, the optional tax is from the next year. Next year as in this particular year which is there for your syllabus. It was not there in previous year 1920. It is there from previous year 2021. Neil, I didn't get your question properly. So whatever does not get covered in general charge, but we want to create specific charge in general section itself. I didn't get your question properly. If you could elaborate more. See, the section remains the same. So 28(1) of the PGBP is the general charging section. 28(2), 3, 4, 5, all that are specific. I'll explain you how. But first you answer me this question for this 60 years age. What is the answer? Neil, your answer is correct, but not the reasoning. Ambika, no. Yes, Neil. I'll explain you properly, Neil. Yes, Sumit, correct. No, Muthu. So let's see. There is a circular by the CBDT, as well as there is a Supreme Court decision. Let's read into it together. So an individual who is resident in India and of the age of 60 years or more and 80 years or more is eligible for a higher basic exemption limit of 3 lakh and 5 lakh respectively. The contentious issue is regarding the attainment of the aforesaid qualifying ages for availing higher basic exemption limit in cases of the person whose date of birth falls on 1st April of calendar year. In other words, the broader question under consideration is whether a person born on 1st April of a particular year can be said to have completed a particular age on 31st March on the preceding day of his or her birth or on 1st April itself of that year. So Supreme Court in Prabhudayal Sesma case had observed that when it has dealt on the general rules to be followed for calculating the age of the person. Supreme Court observed that while counting the age of the person, whole of the day should be reckoned and it starts from 12 o'clock in the midnight. And he attains the specified age on the day preceding the anniversary of his birthday. Because from 1st April, he would become 61. He completed 60 on 31st March. That was the Supreme Court's observation. So we say that he completed the 60 years time on 31st March at 12 midnight. And he stepped into the next year. So what Supreme Court said is, in the absence of any express provision, it is well settled that any specified age in law is to be computed as having been attained on the day preceding the anniversary of the birthday. The CBDT has by this circular clarified that a person born on 1st April would be considered to have attained a particular age on 31st March, the day preceding the anniversary of his birthday. In particular, the question of attainment of age of eligibility for being considered a senior or very senior citizen would be decided on the basis of the above criteria. Therefore, a resident individual whose 60th birthday falls on 1st April would be treated as having attained the age of 60 years in the previous year 1920 and would be eligible for higher basic exemption limit of 3 lakhs in computing his tax liability for AY 2021. And likewise, it would be for 80 years of person. Are you clear? So when you have to compute the age, it will be on the 31st day of March, day preceding to his birthday, and not from the 1st April. Are you clear? Any doubts? Yes, Ambika, new regime is for individuals. We'll get into it now. Any doubts with respect to this? Any doubts or questions? Okay, so let's proceed further. First, I'll clear the doubt of Neil. Let me take you to the Income Tax Act itself, Neil. So see, The following income shall be chargeable under the head PGBP. So first is the general charge. Profits and gains of any business or profession which was carried on by the assessee at any time during the previous year. Second are the specific charges. First is the general charge. It says profit and gains of any business. Second is a specific charge which says any compensation or other payment due to or received by any person managing wholly or substantially the affairs of an Indian company with respect to modification of the terms. So this compensation is usually capital in nature, but it is to be treated as a general, it is to be treated as revenue in nature by way of this specific charge. So are you clear, Neil? Did you understand now? Neil, I told you the name of the case. Prabhu Dayal Sesma. Are you clear with this particular specific charge? Any other doubt? Anjali, ma'am, if it means if the birthday on 1st April, then on 31st March, he has completed the age? Yes. That's correct, Anjali. Okay. So let's move further now. To the optional personal tax regime. Now this optional personal tax regime, as we saw the rates and the slabs, if you see here the slab was 2.5 to 5 lakhs. Here also that slab is remaining the same and even the tax rate is remaining the same. But the next slab starts between 5 to 7.5. Here it was directly 5 to 10 lakhs 20%. Here it is 5 to 7.5 lakhs 10%. So between 5 to 7.5 lakhs, 10%, which is lower than this 20%. Again, 7.5 to 10 lakhs, 15%, which is also lower than 20%, right? After 10 to 12.5 lakhs, it is 20%. Whereas after 10 lakhs, it was directly moving to 30% under the normal rates. So 12.5 to 15 also it is 25%. And 15 and above, it goes to 30%. Are you getting that? Now, to whom this is applicable and when this option become you can exercise. Now, this optional personal tax regime can be exercised only if you do not claim any exemptions and deductions. That is a rider. So, this optional personal tax regime comes with a rider. What is the rider? That you are not going to claim any deductions and exemptions. So what do we mean by any deductions or exemptions? These deductions and exemptions you will have to forgo. You will also have to forgo LIC premium deduction, tuition fee deduction, medical premium deduction, whatever you used to claim under the earlier normal tax rate. If you want to claim, you go for normal tax rate. If you want to forgo everything, you can come and offer the tax under optional personal tax regime. So all these leave travel allowance, food allowance, HRA, daily expenses, reallocation expenses, children education allowances, other special allowances, except two transfer allowance, daily travel allowance, conveyance allowance and transport allowance for handicap can be claimed. Rest you cannot claim. Even you cannot claim standard deduction. You cannot claim professional tax under the salary. Interest on housing loan is also not permissible. Chapter 6A, except section 80cc D2 and 80JJAA. So rest of the things you cannot claim as deduction. And if you are willing to do that, you can go under the optional personal tax regime. Are you clear? So the option can be exercised only when you want to forgo all the deductions and exemptions. Are you clear? So if a person, say for example, every year will have to do this kind of calculation. What will be this kind of calculation? He will have to compute his income tax by claiming the deductions and calculating at the normal rate. And he has to then calculate the income tax by foregoing the deductions and directly applying the optional personal tax regime on his income. And he has to compute both the options and compare and compute on the basis of both the options which one is better. Okay, so based on that, he will have to decide under which one to go. Do you get that? Do you get that? Any doubts? Any doubts with respect to this? Any doubts? Okay. Muthu, is there any issue in claiming exemption for agricultural income? No, Muthu, that is any which way is exempt. Because as I said, that is chargeable by the state government. Any other questions? Okay. Let's read 115 BAC from the Act also so that it becomes conceptually clear since this is a new section. See, notwithstanding anything contained in this Act, but subject to the provisions of this chapter, income tax payable in respect of the total income of a person being an individual or an HUF for any previous year relevant to the assessment year beginning on or after 1st day of April 2021 shall at the option of such person be computed at the rate given hereunder in the table. Clear? And what are the exemptions which he has to forego? So for the purpose of subsection 1, total income of the individual or HUF shall be computed without any exemption or deduction under clause 5 or 13A or clause 14 or 17 or clause 32 of section 10, which we have covered. Without any exemption under section 10AA, under section 16 of the professional tax and the standard deduction, 24, which is interest on housing loan, or interest on housing loan in respect of the self-occupied property. You can claim it for the rental property. For rental property, you can claim the interest on housing loan deduction. But if it's a self-occupied property, you cannot claim it. Clear? Additional depreciation, other allowance, investment allowances under section 32 AD, 33 AB, ABA, or section 35 scientific research deductions, 35 AD, 35 triple C, 57, or any other provisions of chapter 6A other than 80 CCD2 or 80 JJAA. Clear? Without set off of any losses, carry forward or depreciation from any earlier assessment year if such loss or depreciation is attributable to any of the deductions referred to in clause 1 under the income from house property. So you cannot claim any brought forward losses. By claiming depreciation, you can claim the depreciation but not the additional depreciation. Clear? Is it clear? Now, what do they say about the option being exercised? So they say nothing contained in this section shall apply unless option is exercised in the prescribed manner by the person having income from business or profession on or before the due date specified under 139(1). So if you are a sole proprietor and if you carry on the business or profession, then you can do it before 139(1) filing your return of income for any previous year relevant to the assessment year commencing on or after 1st April 2021. And once such option is exercised shall apply to the subsequent assessment year. Clear? And if you are a person who does not have business or profession income, then you have to exercise the option along with the return of income to be furnished under subsection 1 of 139, which is before the due date of filing return of income. But if you are carrying on the business or profession, once you exercise that option, then you cannot withdraw it. Once you exercise the option, you cannot withdraw, and it can be only withdrawn once. It can be only withdrawn once for a previous year other than the year in which it was exercised, and thereafter if you withdraw, then you will never be eligible to come under this section. Then you will never have the option to come under this section, except when you cease to have the business or profession. Is it clear? So what do they say? That if you have a business or profession, you have to exercise that option before the due date of filing return of income. And that option, once exercised, will continue. If you ever withdraw that option, you will never be able to come in again this particular section. You will never be able to come again in this particular section unless your business is stopped or ceased. If you do not have business or profession, you can always exercise this option again and again every year. So if I do not have any income from business or profession, I can decide on year basis whether I have to come under the normal route or I have to go under the optional personal tax regime. Is it clear? Any doubts do you have? And if you fail to satisfy the conditions, if you fail to satisfy any of the conditions in any previous year, the option shall become invalid in respect of the assessment year, that particular assessment year, and the normal provisions of the Act shall apply. Is it clear? Any doubts do you have? Kunal, did you get it? It's not only for the salaried person. It is for both. Any other doubt? Any other doubt? Did you get this concept very clear? If there are no further doubts, let's proceed further. Now, the surcharge and rebate remains the same for both the options. For option 1 also, like for the normal rates also, and for this also, right? So what is the rebate? Rebate of up to rupees 12,500 for resident individual whose total income does not exceed rupees 5 lakhs, right? And what are the surcharges? If the net income exceeds 50 lakh but does not exceed 1 crore, 10%. If net income above 1 crore but does not exceed 2 crore, 15%. If net income exceeds 2 crore but does not exceed 5 crore, then 25%. But remember one thing, on dividend, short-term capital gain on listed equity shares and long-term capital gain on listed equity shares, the surcharge rate will not be 25%. The maximum surcharge rate, even if the STCG and LTCG crosses 2 crore, would be 15%. So the higher surcharge of 25% will not be applicable on dividend, STCG and LTCG even if they cross 2 crore limit. The highest rate applicable on such income will be 15%. For other category, it will be 25%, right? And if net income exceeds 5 crore, excluding dividend, STCG and LTCG, it will be 37%. Clear? Any doubt? Any doubt? Neil, if multiple businesses and only one of them ceases, then in that case, you cannot withdraw from that. You cannot again get back to the option. The reason is, even if one of your business has ceased, but you will be still having the business income, right? So whatever is ceased, it does not mean, it's just that your operations have ceased. So in that particular case, what will happen is you cannot again go back to that optional personal tax regime. You will have to still follow the normal route unless all your businesses are shut. Clear? Any other doubt? Clear? Should we proceed further then? Moving to the cooperative societies, the tax rate for them. The taxable income, again, it's based on the slab rate. Up to 10,000, it's 10%. 10,000 to 20,000, it's 20%. Above rupees 20,000, it's 30%. And surcharge, if the income exceeds 1 crore, it's 12%. Now, for cooperative societies also, an optional scheme has been introduced under section 115 BAD. What is that optional tax scheme? It says a cooperative society can opt to be taxed at 22% rate plus a flat surcharge, not dependent on any income threshold. A flat surcharge of 10% plus cess of 4%. Now again, what is this optional tax regime? Under optional tax regime, a cooperative society will have to forgo all the deductions and exemptions. What are the deductions and exemptions that it will have to forgo is the additional depreciation, the investment allowances, the scientific research expenses, even ATP, which is one of the very important deduction available to cooperative societies. That also it will have to forgo. And it will get 22% rate plus flat surcharge of 10%. Are you getting that thing? So why these optional tax regimes are being introduced? These regimes are introduced to simplify the tax assessment. So if you claim deductions, your income is assessed, your scrutiny is taken up, and then the AO examines whether that deduction was allowable or not to the assessee. But to avoid that hassle, you can just, if you do not have a higher deductions, you can just submit your return by offering your income at the flat rate without doing any of the hassles. That will save you your time as well as the department's time from scrutiny. Clear? That is why these optional tax regimes have been brought up to simplify the tax assessment. Let's look at 115 BAD once under the Income Tax Act. So notwithstanding anything contained in this act, but subject to the provisions of this chapter, income tax payable in respect of the total income of a person being a cooperative society resident in India for any previous year relevant to assessment year beginning on or after 1st April 2021 shall at the option of such person be computed at the rate of 22% if the conditions are satisfied. Right? And if you do not satisfy any condition, the option will become invalidated and the normal provisions will apply. So what are the total income, how it will be computed without any deduction under 10AA, additional depreciation, investment allowances under 32AD, 33AB, 33ABA, or scientific research expenses under 35, 35AD, 35CCC, or any of the provisions of Chapter 6A other than 80JJAA, meaning ATP will also not be allowed. Are you clear? Without any set-off of loss carry forward or depreciation, if it is attributable to the deductions referred to in 1, depreciation will be allowed, but not the additional depreciation. Clear? Is it clear? So that is how your 22% rate would be computed. And there will be a deduction which will be allowed for units in International Financial Service Center under 80LA. But other than that, no other deductions will be allowed for a cooperative society. Clear? When is this option to be exercised? This option is also to be exercised on or before the due date of filing return of income. And once the option is exercised, it cannot be subsequently withdrawn for the same or any other previous year. It shall apply to the subsequent assessment years also. Clear? So what cooperative societies will have to do is, they will have to compute by claiming the deductions, what will be their tax rate, and without claiming the deduction by going into this optional regime, what will be the tax rate, and will compare and then decide which one is the better option. A question could be similarly asked in your examination. What and how the question will be targeted? The total income sum will be given based on, say, PGBP. The deductions will be given, scientific research expenses, investment allowances, all of that will be given, additional depreciation. At the end, you would be asked whether a person, whether the cooperative society should go into this particular scheme or the normal scheme. Or you would be generally asked, determine the tax rate, determine the tax and the taxable income. If you are asked, determine the tax, then in that case, remember, whenever it's a cooperative society question, you will have to think about both the options. Under the normal also, because there could be an ATP deduction also given, right? So entire sum of the cooperative society will be based on the ATP, and you have to compute in under both the options. Similarly, for an individual also, you will have to decide based on both the options. Say, for example, a sum could come from a salary point of view, and then you will have to decide which of the options seems better. If you disallow the standard deduction, if you disallow the professional tax, if you disallow interest on housing loan, all of that will be given. And then you will have to compare. All proprietor based on the PGBP deductions. Clear? Any doubt do you have? If you have any doubt, you can ask. Anjali, you need not mug up all this section. You just need to practice more and more. Because if you see, the logic of this section remains the same. You have to remember the tax rate. There is no doubt in that. But once you remember the tax rate, you know, when you have an optional regime, if you want to go under optional regime, there are certain set of deductions which will not be available and which are common for every section. These are common for cooperative also. These are common for individual also, right? We saw investment allowance will not be available. We saw additional depreciation will not be available. Scientific research not available. 10AA not available, right? So all the allowance will not be available. Except in the case of individual, there were only few allowances which are available, which are conveyance allowance. So remember like that, right? 80cc D2 will be available. That's it. So other than that, nothing else is available. No deductions or allowances are available. So it's very simple to remember. The logic is you can claim concessional rate without claiming any allowances of deductions or exemptions. Clear? Sumit, what about unabsorbed depreciation? As I said, unabsorbed depreciation pertaining to these will not, pertaining to additional depreciation will not be allowed. Clear, Sumit? Except in the case of the, see, when you go to the PGBP chapter, there you will come to know more about detail, because if I'll tell you now, that will not have the link. So under PGBP, there is a provision that additional depreciation up to half you can claim in the current year, and the next half you can claim it in the next year. So that half which you have not claimed in the current year and which is to be claimed in next year, that will be adjusted in the WDV. That will be adjusted in the WDV. So that you will come to know once you have your PGBP lecture. Surcharge rate is 15%, Muthu. It's correct. Neil, the specific section of short-term capital gains are not overruled if the option is exercised. A very important point. So what does this section say? Let's read it once again. If you see, it says, notwithstanding anything contained in this act, but subject to the provisions of this chapter. Now, this 115 BAD is put under special rates chapter. And there are certain special rates other than this particular section, which are for, say, STCG on listed, LTCG on listed, right? There are certain special rates for the certain specified income. Now, if there is STCG on listed equity shares, that will not be covered under 22%, but for that it will be 15% rate only. Because this section is saying, notwithstanding anything contained in this act, but subject to the provisions of this chapter. So this section is subject to the special rates under this particular chapter. This chapter meaning the special rates chapter. Clear? So even under 115 BAC, the language was similar. If you see, let's see 115 BAC. It says, notwithstanding anything contained in this act, but subject to the provisions of this chapter. So for an individual who has, say, LTCG from listed equity shares would not have these slab rates, but will have the tax rate of 10%. Clear? So this is subject to the provision of this chapter. If an individual is an NRI, then we had seen chapter 12A is applicable, right? Chapter 12A is applicable, which is under this chapter only. There are specific tax rates for NRI, right? So that will prevail over this. That will prevail over this. Are you clear? Is it clear? Any doubt? Neil, did you get the answer? Any other doubt? Yes, Neil. For computation of LTCG, cost of acquisition would be allowed as deduction because for that we are not going into personal tax regime. So that is a specific rate under chapter 12 and that is to be computed separately. So it is subject to the provision of this chapter itself, right? So for that you will deduct the cost of acquisition because that is not going under this particular tax rate but under 112A section. Clear, Neil? So if there is a specific tax rate which is there, then that is to be computed separately. Clear? Because it says notwithstanding anything contained but subject to the provision of this chapter. Now, there was a separate chapter of non-resident Indian. I'm not talking about only non-resident. Non-residents have under this section, under this chapter only. There were this non-resident Indians for whom there was a separate chapter 12A. Remember, where the investment income and LTCG were taxable at a special rate. Whether that rate will apply or that non-resident individual can go for optional personal tax regime. What do you think is the answer? Do you remember chapter 12A for non-resident Indians we had done? What do you think? Whether that particular 10 and 20% rate would be applicable or this will be overridden, those investment income and LTCG will be overridden by this particular optional personal tax regime. What do you think? What do you think? So if you see this particular 115 BAC, right? This particular provision 115 BAC comes under chapter 12. And for the non-resident Indians, which we have learned under international tax lecture, that was coming under chapter 12A. So, if you see what 115 BAC says is, notwithstanding anything contained in this act, but subject to provision of this chapter. This chapter meaning chapter 12. It is not subjecting itself to chapter 12A. So even chapter 12A would get override by 115 BAC. So for non-resident Indian, he will have to choose between chapter 12A and 115 BAC, which one is beneficial to him. Are you clear? Under 115 BAC, there are the slab rates. Whereas under chapter 12A, there was this 10% on LTCG and 20% on investment income. Do you remember? So, if he has only that income, he can go for chapter 12. If he has other incomes also, then his LTCG and chapter 12A, LTCG and investment income would fall under 115 BAC. Then in that case, what he can do is, he can exercise the option of 115 BAC and get his LTCG taxed as per 112A instead of chapter 12. Are you getting that point? So what he can say is, he can go for 112A instead of going for a specific chapter, right? Because under 112A also tax rate is 10%. Then that particular option will not apply to him of chapter 12. Is it clear? Are you getting this? Yes, Neil. Sumit, chapter 12A is different. Anjali, it is for resident as well as non-resident. If you read the provision, it says individual or HUF. Total income of a person being an individual or HUF. It does not say resident. Clear, Anjali? Any doubts? Yes, Neil. Any doubts? Did you understand the concept well? Okay. So what we do is we take a break of 15 minutes and we get back and we start then with the next part of it. Clear? So let's take a break of 15 minutes. Okay, so let's start with it again. There are few doubts which I'll take up. Neil, I'll repeat again with regard to the capital gain part. So what you have asked is that there is this NRI specific rate under the head capital gain, right? Which was 10%. Now 115 BAC says that it will be subject to the provisions of that particular chapter. For NRI, the chapter is different. So then it will override that chapter. Clear? What NRI can do is, if it has capital gain income, then on the capital gain income, then it can choose to go under chapter 12A instead of chapter 12. But if it has other incomes also, then the best thing it can do is, it can go to chapter 12. Under chapter 12, it will go for 115 BAC. For 115 BAC, it will see that the other incomes are taxed under 115 BAC and the capital gain will be taxed under 112A, which is normal provision for listed equity shares. Right? So it will not go to the specific NRI chapter, but it will go under the general 112A section itself. Clear? Because that is permissible. 112A will fall under that particular chapter of where 115 BAC is falling, right? Under chapter 12 itself. Both chapter 12, under chapter 12, 115 BAC and 112A, both are falling under chapter 12, right? So that is permissible. So he can get taxed for capital gain under 112A and for the balance income under 115 BAC. Clear? But it cannot go to chapter 12. Clear, Neil? Any other doubt? Neil, is it clear? Okay, so we proceed further now. For firms, the tax rate is 30% and surcharge is 12% if the income exceeds 1 crore. Firms include partnership firm as well as limited liability partnerships. Clear? For companies, let's see what are the tax rates for company. There are different tax rates prescribed for the company. A domestic company, if the total turnover or gross receipts of the previous year 1920 it should be does not exceed 400 crore, then it should be 25%, right? For others, it is normal tax rate is 30%. If a company is a new manufacturing company, then it will be 15%. And if it is a normal company, but it goes for an optional scheme, then the tax rate is 22%. So I'll write it in this particular, I'll write down for you. What are the different tax rates for companies? So, domestic company, a manufacturing company, the tax rate is 15%. Optional scheme is 22%. The smaller company where turnover is less than 400 crores in previous year 18-19, it is 25%. And other companies which are not falling under any of the criteria, the tax rate will be 30%. Right? So this is the tax rate for domestic companies. Now, what are these 15% and 22% tax rate? Let's look into the specific section. The new manufacturing companies which are there, they fall under 115 BAB. And this is under 115 BAA. This is coming through Finance Act. Clear? So what are these 115 BAB and BAA saying? 115 BAB is only for the manufacturing companies. 115 BAA is for the other companies. Let's try and look into these particular sections. So what does 115 BAB says? Notwithstanding anything contained in this act, but subject to the provisions of this chapter. Again, the specific rates will override this general rate. If a company has capital gain on listed equity shares, then it will be 10% and it will not come under 115 BAB, right? For the other incomes, it will be under 115 BAB. Other than those mentioned under section 115 BA, so 115 BA was existing till 2019. After 2019, this particular provision is there. And 115 double BA, which is for the normal companies, right? So notwithstanding anything contained in this act, but subject to the provisions of this chapter, other than 115 BA and BAA. So it overrides 115 BA and BAA also, right? Because it says subject to provision of this chapter other than 115 BA and BAA. Clear? So 115 BA was for the company manufacturing companies incorporated between 17 and 2019. And this is after 2019. So it overrides 115 BA and 115 BAA. The income tax payable in respect of the total income of a person being a domestic company for any previous year relevant to the assessment year beginning on or after 1st day of April 2020 shall at the option of such person be computed at the rate of 15%. Again, this is an optional provision for manufacturing concerns. Again, this is an optional provision. It's not a mandatory provision. 15% rate is given. It's subject to the caveat which is provided under subsection 2. What does subsection 2 says? That the certain deductions are not to be claimed. And we'll see which deductions are not to be claimed. But let's read the proviso. Provided that where the total income of a person includes any income which has neither been derived from nor is incidental to manufacturing or production of an article or thing, and in respect of which no specific rate of tax has been separately provided under this chapter, then such income shall be taxed at the rate of 22% and no deduction or allowance shall be allowed in computing such income. What does this mean? That if there is an income which is not related to the manufacturing, if there is an income which is not related to manufacturing or production of an article, that particular income, if there is no specified tax rate for such income, then that income will be taxed at 22% and not at 15%. So what does it say? What does it say? Manufacturing income will be taxed at 15%, right? Specified tax rates, if they exist, then at those rates. And if not manufacturing income and no specified tax rate, then 22%. Are you clear? So 15% and for the manufacturing. If there is specified income for which specified tax rates exist, then at those rates. For example, LTCG or STCG, right? Right? If not a manufacturing income and no specified tax rate, then it will be taxed at the rate of 22%. Clear? Then it says, provided further that no income tax payable in respect of the income of a person deemed so under second proviso to subsection 6 shall be computed at the rate of 30%. We'll see what the subsection 6 says at later point. Right? And it says that provided also that the income tax payable in respect of income being short-term capital gains derived from transfer of capital asset on which no depreciation is allowable under the Act shall be computed at the rate of 22%. So in case of short-term capital gains, say on the sale of land on which no depreciation is allowed, that shall be at 22%. What will be the case in case of listed equity shares, short-term capital gain in case of listed equity shares? That will be continued to be taxed under 15%, because for that there is a specified tax rate. But if there is a short-term capital gain on sale of asset on which no depreciation is claimed, that will be taxed at 22%. Clear? Then it says, where a person fails to satisfy the conditions in subsection 2, option shall become invalid and the other provisions of this Act shall apply to the person as if the option had not been exercised. Clear? Now, what are the conditions under subsection 2? The company has been set up and registered on or after 1st day of October 2019 and has commenced manufacturing or production of an article or thing on or before the 31st day of March 23. This is the first condition, that the company should have been registered on or after 1st day of October 2019 and has commenced manufacturing or production before 31st day of March 2023. And the business is not formed by splitting up or reconstruction of a business already existing, does not use any plant or machinery previously used for any purpose. Then what is the third condition? Does not use any building previously used as hotel or a convention center. So these are some of the conditions which they have given up. Clear? The company is not engaged in any business other than the business of manufacture or production of any article or thing and research in relation to or distribution of such article or thing manufactured or produced by it. So it should only be engaged in the business of manufacture or production. It should not be engaged in service sector. Clear? So it should be either in the business of manufacture or production or research in relation to such manufacturing. Clear? They have given what is the meaning of manufacturing of business, and they have said it is hereby clarified that the business of manufacture shall not include development of computer software, mining, conversion of marble blocks, bottling of gas into cylinder, printing of books, any other business. Now, these things you will have to remember. There could be a question asked that a person is engaged in the printing of books. And that time, at the end, it will be asked, compute the tax on the total income. So you will have to write in the note that this 115 BAB will not apply to such a person because it is not considered as manufacturing. Clear? The total income has been computed without deduction under 10AA, without additional depreciation, investment allowance, scientific research expenditure, clear, or any other provisions of Chapter 6A other than 80JJAA. 80JJAA is for employment related deduction. Clear? Without set off of losses or allowance for unabsorbed depreciation, and depreciation will be allowed but not the additional depreciation. Clear? So this is what 115 BAB says. It says that you can claim this 15% rate if you do not claim any deductions, if you commence the manufacturing operations before 31st day of March 2023, and if you commence your or register your company after 1st April 2019. Is it clear? Any doubts? Any doubts? Again, the option shall be exercised before the due date of filing of return of income. And once such option is exercised, it shall apply to subsequent years. It cannot be subsequently withdrawn in this particular case also. Clear? Any doubts you have with respect to this section? Any questions? So again, if the question comes in exam on manufacturing under the heading, there will be no clear indication that this section has to be applied. Just it will be mentioned that the company is engaged in manufacturing. And at the end, it will be mentioned compute the tax on total income. Then you will have to compute the tax based on claiming the deductions. You will apply 30% tax rate. And without claiming the deductions, you will apply 15% tax rate. And you will compare both the options and then decide. Are you clear? Also, one very important thing, do not forget, you will have to see the MAT provision also, unless it is mentioned in the question that the MAT has to be ignored, right? So in that particular case, you will have to see MAT provision also for the normal provision, that whether MAT the liability under the MAT is greater than 15% of the normal tax. You will have to compare that also. So what you will have to do is, if a question comes under this particular section, remember your step 1 will be compute total income by claiming deductions, apply 30% rate. Clear? Second, compute MAT. See if 2 greater than 1, then MAT applicable. If not, then 1, normal provision. Then compute total income by foregoing deductions. Apply 15%. Compare 3 with 4 and decide. Right? So if MAT comes as the answer under 3, then you will have to compare MAT with the 4 under 115 BAB. But if normal provisions come, then you will have to compare normal provisions with 15%. Are you clear? Getting this? MAT do not apply for 115 BAB. MAT do not apply for 115 BAB. Is it clear? Is it clear? And for 115 BAB, flat rate of 10% of surcharge apply. So here surcharge irrespective of total income will be 10%. Is it clear? Irrespective of the total income, the surcharge is 10%. Any doubts? Any doubt? Okay. Let's go to the next section then, if there are no doubts, which is 115 BAA. What does 115 BAA says? Again, it says notwithstanding anything contained in this act, but subject to the provisions of this chapter, other than those mentioned under 115 BA and BAB. So 115 BAA overrides 115 BAB and 115 BAB overrides 115 BA. In a way, if it's a manufacturing, you have to go under 115 BAB. If it is normal company, then you come under 115 BAA. Clear? The income tax payable in respect of total income of a person being a domestic company for any previous year relevant to the assessment year beginning on or after 1st day of April 20 shall at the option of such person be computed at the rate of 22% if the conditions under subsection 2 are satisfied. If any of the condition is invalidated, then the entire option will get redundant and the normal provisions will apply. Clear? For the purpose of subsection 1, the total income of the company shall be computed without any deduction under 10AA, without additional depreciation, without investment allowances, scientific research, and Chapter 6A other than 80JJAA. No loss brought forward will be allowed if the depreciation or loss is attributable to the deductions under subsection 1, right? And normal depreciation will be allowed. Is it clear? So this also provides for 22% rate without claiming any deductions. But this is for other than manufacturing companies. Clear? And again, this option has to be exercised before the due date of filing return of income. And once this option is exercised, it shall also apply to the subsequent years. Clear? Is it clear? Any doubts? Also, one very important point. If due to any reason 115BAB, 115BAB, which was for the manufacturing, right? If in that case you fail to satisfy the condition, if in that case you fail to satisfy the conditions, then 115BAA gives you the option to come under this section. So say for example, you violate the condition of 115BAB for manufacturing. Then you, instead of going to 30% tax rate, you can come to 22% rate. You can come to 22% rate. Clear? So you may not directly go to 30%. You will still have the option to exercise this particular provision, 115BAA. Clear? But once you have exercised this option, you cannot subsequently withdraw. Is it clear? If you have any doubts, you can ask me now. Okay, let's move further then. MAT will also not apply for 115BAA also. It will not apply for 115BAA as well as for 115BAB. Again, what you will have to do is you will have to compare 115BAA 22% with the 30% tax rate as well as the MAT. So 30% and MAT will apply simultaneously. Amongst that, whichever will be the higher tax liability will be compared with the 22% rate, and whichever is beneficial for the assessee, you will advise that particular rate to be opted. So again, such kind of question could be targeted for your exam because this is very important. The surcharge for the normal company is if the income exceeds 1 crore but is less than 10 crore, 7%. Where the total income exceeds 10 crore, it is 12%. And for 115BAA and BAB, it is flat 10% irrespective of the total income. Clear? For the foreign company, tax rate is 40%. For the foreign company, tax rate is 40%. For domestic company only, these tax rates were applicable. And for foreign company, surcharges where income exceeds 1 crore but is less than 10 crore, 2%. Where the income exceeds 10 crores, then 5%. Clear? Is it clear till now? We have finished the tax rates. Before we go on to the next part, I'm giving you 2 minutes time to ask me any questions if you have, or if you have not understood any concept. Any concept if you want me to repeat. Any doubts or any concept you want me to repeat? Okay, Ambika. So what I said was, look at this particular slide. First, you have to compute the total income by claiming all the deductions. And then for that, if you claim the deductions, you will have 30% tax rate, right? Then you will compute the MAT at the rate of 15%, right? Because MAT applies. When the normal provisions are applicable, MAT also applies. And you will have to check whether the liability under the MAT is more than the liability as per the normal tax provision, right? If the liability under the MAT is more than the normal provisions, then in that particular case, MAT, the tax will be as per the MAT, right? So if it is as per the MAT, then under step 4, what you will have to do is you will have to remove all the deductions. By foregoing all the deductions, you apply 15% tax rate. Once you have 15% tax rate, you will compare not with the normal provision. Because any which ways, if you are going under normal provisions will not apply because the liability under normal provisions was lesser than MAT. So you will compare the tax as per 15% with the MAT. And once, if you find that the tax rate as per 15% is more beneficial compared to what you would have paid under MAT, then in that case, the 15% tax will apply. Are you clear? The tax as per 15% will apply. And surcharge of 10% will be added. So once you are going under 115BAA or 115BAB, MAT does not apply. Clear? But if you are going under normal provisions, then MAT will be applicable. Also, say for example, under 115BAA, BAB, the companies which are incorporated after 1/4/2019, only that can go under 115BAB. But if you see 115BAA, it is for existing companies also. It is for existing companies also. So possibly the existing companies might have some MAT credit of earlier years also, right? If that is the case, they will have to forgo the MAT credit also. Because for such companies which are going under 115BAA, no MAT is applicable. So you cannot claim any MAT credit. So what you will have to do is, a question can again be asked in the exam that whether you utilize the past year's MAT credit and then in the subsequent years you go for 115BAA, or you forgo the MAT credit and in the current year itself you go for 115BAA. Right? So those could be the kind of questions which could be targeted. Clear, Ambika? Any other doubt? Ambika, did you get the concept now? Kunal, you will have these examples when you will have the math lectures as well as when you will have PGBP lectures. Point is, because there you will study in detail about the deductions and exemptions. Today we are in the basic concept class. So that time you will have these examples for sure. And that time the concept will become all the more clear once you solve these examples. Because it will be again touched upon in those class also. Okay, so let's move further. Now, while interpreting any particular statute, there are some rules of interpretation which have been developed over the years. With the income tax in mind, again for interpreting Income Tax Act also, we have to keep these rules under mind. What are these rules of interpretation? Literal interpretation. what does this rule mean? That you have to understand the provision as it is existing. You have to understand the provision as it is existing. You do not have to read in between the lines. You have to interpret it literally the way it is written. That is the meaning of literal interpretation, right? So say for example, there is section 57, which requires expenditure which can be deducted against the income. Expenditure which can be deducted against the income on. It does not require that expenditure shall only be deductible if the income is earned. So there could be a possibility that I have incurred some expenditure. I have borrowed the money. I have incurred the interest expense. I had borrowed the money for making investments. But I could not make up the investments, or the investments were not profitable, or for that matter, there was no dividend declared on those investments, right? So it is not necessary that if I have put in the money in some investments, that should fetch some revenue. Quite possibility that this year I have not received any revenue. So in that case, the question arises whether the interest will be deductible. The answer is yes. It does not require, the provision does not say that the expenditure will be deductible only if the income is earned. It says expenditure shall be deductible if it is made for earning the income. I had made the expenditure for earning the income, but it's not that the case that if I have not earned the income, I will not get the expenditure deduction, right? So that is literal interpretation. You have to interpret the provision as it is without looking in between the lines or without looking at the purpose or intention of the provision. Clear? Then the other rule of interpretation which is generally used is the mischief rule. What is this rule? It's also called as Hayden's rule. It means that you look at the intent of the provision, that why this particular provision was introduced. Why this particular provision was introduced to close a mischief or a loophole existing under the law, right? So there could be a possibility that there was some loophole under the law which was allowing tax avoidance. To close that loophole, the provision might have been introduced. So you have to look at the provision of the law, why it was being introduced and what was the loophole it tried to close and what was the loophole existing before that. So there is this section 45(4) which we'll see under the capital gain class, that if there is retirement of the partners from a firm that was earlier not covered, under capital gain. So capital assets distributed on retirement of partners of firm was not earlier covered, and that was leading to tax avoidance because no tax was paid on the capital assets distributed to the partners who is retiring. Therefore, 45(4) was introduced to close that loophole. So if you interpret ever 45(4), you have to look why particularly this provision was introduced and what mischief is tried to close. Clear? Golden rule. Golden rule means you have to look at the purpose of the provision. So sometimes there could be a situation where while interpreting a provision, you need to know the purpose with which this provision is introduced. Whether the purpose was to grant a deduction to the assessee, even in cases not expressly covered by that provision. So that is the intention of the golden rule. You have to look at the intent of the provision, what it is trying to allow. Clear? So there could be a provision, say for example, of deduction, which allows a deduction only on submitting a certain form. There are these ICAI deductions or 10AA deductions, which are only allowed if you submit certain forms. If assessee fails to submit the form, that should not lead to the non-eligibility of claiming that relief or non-eligibility of claiming that benefit, right? So you have to look if the purpose was to induce more investments, if the purpose was to give an impetus to investments of that provision. In that case, just because a compliance is not made or it's made at a later point in time, that should not lead to disallowance of that provision, right? That is the purpose of golden rule. Clear? Principle of beneficial construction. you have to construct a provision or you have to interpret a provision which is beneficial to assessee. Similar example, if a provision has been introduced which is for the benefit of the assessee, then the benefit should be given even if it goes against the literal interpretation. So say for example, additional depreciation. Earlier, additional depreciation was allowed for only if the assets are purchased for less than 180 days, then the additional depreciation was allowed only at the half rate. But that, if you see the purpose of that additional depreciation, it was to increase the investment in plant and machinery. So the courts had interpreted that provision that half percentage would be allowed in this year and the balance would be carried forward to the next year. Now that has been expressly put under statute, but at one point in time that was not so express. And that is where this beneficial construction comes into picture. Clear? Then harmonious construction. Harmonious construction means that you have to read two provisions in line with each other. So say for example, just now we saw 115 BA and BAB, right? So if you are not opting for 115 BAB, you can directly go under 115 BAA, right? So you have to construct two provisions harmoniously. You should not construct the provisions in isolation. Clear? What is the meaning of agistum de generis? This means that a word which is there at the end, is deriving the meaning or the color from the words which are associated with it. So say for example, if there is a term otherwise appearing under the act, under any provision, you have to read that word in the context of the words which are aligned with it, right? And you have to draw the meaning from the words which are written with it. Clear? That is the meaning of agistum de generis. Nociteresis, what does this mean? That if a word is in between, you have to derive the meaning from the words which are surrounding it. Agistum de generis is the word at the end. Nociteresis is the word which is in between. Clear? Stare decisis. This rule means that if a particular interpretation has been existing since a long time, then there is no reason to change it suddenly. So if a particular provision has been interpreted since many years, suddenly there should not be a change in the interpretation. Are you clear? So these are just some rules of the interpreting any statute, but I have more specifically talked about Income Tax Act. Clear? Any doubts? Any questions? Okay, so if there are no further doubts, we can move further. Under Income Tax Act, there are different provisions. Charging section, we saw section 4. There are specific charging section under different heads of income also. Then there are machinery provisions. What are machinery provisions? Machinery provisions which make the charging section workable, like filing of TDS returns, payment of self-assessment tax, filing of income tax returns. So only when you have this machinery in place for collection of taxes, for filing these returns, only then you can see whether the charging provisions have been applied correctly, whether the income has been computed correctly. Then there are penal provisions, right? The penalties which are there for non-compliances. Then there are certain deeming provision which deems certain receipt to be income even if it is not. Then there are appeals and refunds mechanism, right? That if the assessment is not in favor of the taxpayer, how the appeals can be made, how the refunds can be obtained. So any particular statute is divided into these kind of provision. Now always remember, charging sections are to be interpreted literally. Why? Because a charge, whenever it is made, it has to be very clear whether a particular subject falls under the charging section or not. So a charging section is to be construed in a literal manner. Machinery provisions should be constructed in a beneficial manner. Why beneficial manner? Because even if some lapse has been made by the taxpayer, it should not lead to penalties. A small lapse, so if you see, always there is a reasonable cause always put up under the machinery provision. A reasonable cause is shown that a provision is not complied with. Then the exemption is granted from penal provision. So machinery provisions are to be construed in a liberal manner. Penal provisions are to be construed strictly. Penal provisions are to be construed strictly, right? Again, deeming provisions are also to be construed literally because they create a deeming fiction. So again, a specific wording which is mentioned should only be looked at and nothing beyond. Clear? Any doubts with respect to this? Or any questions? Any doubts? Okay, let's proceed further. If there are no further doubts. Aids to construction. So now, what could be the references which we can make while interpreting the statute? So as you know, Income Tax Act or the income tax in general consists of Income Tax Act, Income Tax Rules, Finance Act, the case laws, the circulars and the notifications. All that are to be taken together while interpreting Income Tax Act. What are the internal aids to construing a statute? So there are always the internal aids, which are the integral part of the Income Tax Act itself. And then there are external things. If internal aids are not able to make you understand the provision, then you can resort to the external aids also. What are internal aids? Explanations. So there are these explanations given in the section itself, which try to enlarge the meaning of the provision by making you understand what a particular provision implies or how a particular provision under that, if a definition, if a term is mentioned, how that term is to be understood. So there are these explanations given under the Act, which are integral part of that section itself. So explanations are to be read along with the section. There are these provisos, like we understood in this 115 BAA also, provided that, provided further that. Now, what are these provisos? They are creating certain kind of exceptions from the main provision. Provisos create an exceptions to the main provision, which again, while reading this section, you will have to take into consideration the provisos. What exception they are trying to create, right? So if there is a main provision, there is an exception to that, that is provided under proviso. Provided further that, provided also that, right? These are all provisos. Non-obstant clauses. What are non-obstant clauses? Notwithstanding anything contained under this act, then you will have to notice that it overrides the entire act itself, and that provision prevails over all other provision. That is a non-obstant clause. Marginal notes. There are these headings to every section. So if you see, there is a heading to this section also, which says tax on income of certain domestic companies. So while you are interpreting a particular section, you always have to look at the heading also. That heading gives you some intention. That heading gives you some reasoning what the provision is all about. All right. So the provision has to be interpreted in line with its marginal notes and headings. Whenever a finance bill is passed, there are notes given to that sections also under the Finance Act that are also to be referred. What are those marginal headings saying under the Finance Act? Clear? What are the external aid? External aids are legislative history. You have to, when you are interpreting a provision, the codes generally go into the history of that section. What was the section before? Why the section has been amended? What is the reasoning behind? And how the history has evolved over the years of that particular section. So as to interpret that section in line of the current scenario. Clear? Circulars and notifications. That also you need to refer to understand the Income Tax Act. Sometimes the explanations are given under the circulars. The meaning of the section is elaborated through the way of circulars and notifications. So that has also to be referred. Speech of the Finance Minister. Sometimes while interpreting a provision, the intention is drawn from the speech of the Finance Minister. Why Finance Minister introduced this provision? She must have given some reasoning to that. So that can be resorted to interpret a provision. Memorandum to the Finance Bill. That has generally the explanations given before a section is introduced or before an amendment is made. That helps us in understanding why the amendment was made. So that can be resorted to understand a particular provision. Are you clear? Is it clear till now? Any doubts? Any doubts you want to ask or any concept you want me to repeat? Before we move to the last part. Okay, so if there are no further doubts, let's move to the last part, capital versus revenue income. Now, as I said, income is defined in an inclusive manner under section 224, right? Now, income, if you see, let's go to the definition of income. Income includes, there is a whole list of provisions what is included under income, right? So there are a lot of inclusions in the income. Some are generally of revenue character which are specifically included. Some might be of capital in nature but still put under the income definition, right? Now, what does the income generally comprise of? There are certain tests. If it's specifically mentioned under 224, it is taxable as income. But even otherwise, there could be a category of income which might not be included in the definition. And since the definition of income is inclusive definition, there could be the incomes which could be further included, which are not expressly mentioned, but which might get still covered. Right? It's just the illustrative list of what is covered. Inclusive definition is always the illustrative list of what is covered. Right? So in that particular case, regular versus the casual. Now, what is this distinction of regular versus the casual? So, income, whether it includes only the regular source of income or it sometimes even includes the casual source of income. Now, regular source of income means the periodic return which I am getting, which is accruing to me at definite point in time. However, there could be the casual incomes also, which are one-time incomes or which are one-time receipts. I'm not calling them income as of now, which are one-time receipt. Whether that could get classified under the definition of income, what do you think? Can you give me answer in the chat boxes? What do you think? Whether casual incomes or casual receipts are also included under the definition of income? Can you tell me in chat boxes? Whether only regular sources of income or casual sources of income also gets covered. Quickly in your chat boxes. Yes, Neha. Whether regular sources or casual. Yes, Kunal. So even casual sources of income can also get covered. Example is winning from lotteries, crossword puzzles. These are one-time income. But these are specifically mentioned under the definition of income also, right? Lotteries, crossword puzzle, race horses. These are not the regular source of income. These are something which can be casual source. So therefore, these are covered within the definition of income. Revenue receipt versus capital receipt we'll deal later. Net versus gross. Net versus gross meaning the income could be on the net basis after claiming the deductions. Some of the incomes can get taxed on the gross basis also. Like we had seen under 115A, the special tax rates which are there usually it is on the gross basis, right? The tax rate is applied on the gross basis. So even the gross incomes as well as net incomes get covered. Due versus receipt basis. Income, a receipt can be considered on the due basis also, on the receipt basis also. It depends on the method of accounting followed by the assessee. Income tax allows for accrual method as well as cash method. For professionals, we usually follow cash method of accounting. So it includes the income on the due basis or accrual basis also, as well as on the receipt basis also. Clear? Now, what is revenue receipt versus capital receipt? Now, there are some income which are recurring in nature, which are drawn from the ordinary course of business and which are routine kind of income. These are revenue receipt. The incomes which are casual in nature are generally capital receipts. So, how do you determine the capital versus revenue income? Right? So, transaction entered into ordinary course of business are generally considered as revenue income. So it depends on how do you treat the asset. If, say for example, shares are part of your stock in trade, then it will be considered as revenue income. Whereas if the shares are considered as investments in your balance sheet, it will be considered as capital income. All right? It is considered as capital income. It is not revenue income. Then it is in the nature of dividend or in the nature of interest. But if it is stock in trade, it is considered as business income. So you have to see whether the shares are bought for trading versus investment. Similarly, if the buildings are held as stock in trade, it could be considered as business income, right? Whereas if it is your capital asset, then in that case, it could be taxed under the head capital gains, right? So it depends on how do you classify the asset, whether it is for the transaction entered into ordinary course of business or it is outside the ordinary course of business. For foreign portfolio investors, even if they classify the shares for the foreign portfolio investors, even if they classify these shares as stock in trade, still for them the income will be under the head capital gain and not business income. This is a carve out which is made for foreign portfolio investors. For foreign portfolio investors, it will always be the capital gain income even if the shares are considered as stock in trade. What are the other tests to decide capital versus revenue income? Whether it's a single transaction or a routine transaction, as I said, right? Now we shall deal into these kind of categories. Gifts. Gifts are not something a routine transaction. Gifts are not something routine transaction, and therefore these are capital income, but they are specifically made to charge to tax under section 56(2)(10). Now see, 56(2)(1) is the general charging section for income from other sources. 56(2)(10) is a specific charging section for capital incomes. Gifts are capital income, but they are made specifically chargeable to tax, right? Compensation on termination of agency. When you terminate the agency relationship, that compensation is generally one time. It's a capital income, but specifically chargeable to tax under section 28, under specific charge, right? Liquidated damages. If you make the compensation for some damages caused to the supplier, it is capital in nature, but it is treated as if it's not created as, there's no specific charge created for that, and therefore it will not be chargeable to tax as income. So if there is a specific charge created for capital, only then it will be taxed. So revenue, unless specifically exempted, will always be chargeable to tax. Capital, unless specifically mentioned, will not be chargeable to tax. Are you getting the difference? Why capital versus revenue is important? The difference is important because revenue income will always be chargeable to tax unless specifically exempted. Capital income, on the other hand, will not be chargeable to tax unless a specific charge is created. For liquidated damages, which are the compensation for, say, loss of machinery, which are compensation for damages, in that case, there is no specific charge for that. That will not be considered as taxable income. Is it clear? Any doubts with respect to this? Any questions? Any doubts or questions? If not, then I'll ask you certain questions which you have to respond to me. But before that, we'll go to case laws, which are important from this chapter perspective. So there is this Tata Tea Supreme Court case. Now, what was this case about? In this case, Tata Tea, as you all know, was engaged in the agricultural business. As I had said, that the tax on agricultural income is under the power of the state government and not central government. And hence, agricultural income is always exempted in the Income Tax Act. Now, this assessee, Tata Tea, challenged section 1150, which is not there for your syllabus now because it's deleted by Finance Act 2020, but which was there earlier. 1150 was a DTT provision on dividends distributed by a company. Now, what this assessee challenged was that 1150 was constitutionally invalid. Why? Because DDT cannot be charged on dividend distributed out of agricultural income. So DDT is charged on all dividends which are distributed, whether out of agricultural income or whether out of normal income. DDT does not distinguish whether the income is sourced from agricultural income or the normal income, right? DDT provision does not distinguish from where the dividends are distributed, from out of which income the dividends are distributed. It is charged on every dividend which is distributed, whether out of agricultural income, whether you have earned that income out of normal business or whatever be the sources, right? This assessee said that this is constitutionally invalid as DDT should not be charged on the dividends distributed out of the agricultural income. Supreme Court observed the definition of income. It said income includes dividend. Supreme Court said that the focus should be on the source of the income. What is the source of dividend? Investments of the shareholders. Source of income is not the agricultural income. Source of the income is investments made by the shareholder. And for an income to be agricultural income, the source should be out of the land which is used for agricultural purposes. Dividends are not arising out of the agricultural income. So though the revenue would be agricultural income out of which dividends would be paid, but the source of the dividend is dependent on the investments and not on the income from which it is being paid. Clear? So Supreme Court said that 1150 was constitutionally valid and the source of dividend is the investments and not the income from which it is being paid. Clear? Is this case clear? Any doubt? Okay. Let's move to next section, next case then. Rental income derived from the unsold flats of the builder, whether it would be PGBP or IFHB. So this was a case of New Delhi hotels. What do you think is the answer? Whether rental income derived from the unsold flats of the builder should be PGBP or IFHB. Without looking at the answer, tell me, what do you think rental income from the unsold flats, whether PGBP will be applicable or IFOS? What do you think? What do you think? Whether rental income from unsold flats, where it will be covered IFHP or PGBP? What do you think? Give me the answer in your chat boxes. If there are unsold flats lying with the builder and if he has rented out those flats, whether it should be chargeable as the income from house property or it should be business income. What do you think is the answer? Kunal, why PGBP? Can you give the reason? Sumit, the carve out is made for FPIs because to induce their investments in stock market. If it is treated as PGBP for them, then it was creating a lot of complication because they were claiming deductions. So a flat rate of tax can be now provided instead of a higher tax rate under the PGBP. What do you think quickly for rental income from unsold flats of the builder? Please give me your answers in chat boxes fast. Quickly give me the answers, please. Sumit, no, the answer is not correct. See, what does section 22 says? Section 22 says chargeability under the head house property unless the assessee is carrying out his business in such house property. Here, the assessee's business was sale of flats, not the letting out of flats. There's a difference. Here, the business of the assessee was sale of the flats, not letting out of flats. So, if the business of the assessee was not letting out of the flats, the income would be taxable under IFHB. Because section 22 says that unless the assessee is carrying out his business in such house property, then only it will be PGBP. Otherwise, it will be IFHB. So, if the assessee is carrying out the business from house property, then only it will go to PGBP. Here, the business of the assessee was not letting out. His business was to sell the flats, right? And therefore, in this situation, this will be taxable under the head IFHB. Clear? Is it clear? Next case. Next question to you is, if the business of the assessee was letting out of properties, the main objective of the assessee under the memorandum of association which was prepared for that company was to acquire and let out properties. Whether in that case it will be PGBP or IFHB. Now what will be your answer? If the main business is letting out of premises, what will be the answer? Quickly in your chat boxes. If the main business is letting out of the properties, then IFHB or PGBP. Kunal Kumar, that will be if the 1150 has deleted, then income from dividend will be taxed in the hands of shareholder at the slab rates for resident, and for the non-resident there are specified rates which we had covered under 115A. I have already covered it in international tax class and will again cover it in the income from other sources class also. Letting out of properties, then PGBP. Yes, Sumit, you are right. If the business is letting out of properties, then it will be considered as PGBP, because this is one of the very important Supreme Court decision in case of Chennai properties. Here, Supreme Court observed that the main intention of the assessee was to acquire and let out properties, and that was his business. And here the Supreme Court held that the deciding factor is not ownership of land or leases, but of the activity, right? So in that particular case, this will be income from business or profession. Clear? Is it clear? Any doubts with respect to this? So, next case. This is again a case in the name of Tamil Nadu Tourism Development Corporation. This is a High Court case. Here, assessee was engaged in tourism and he leased some of the loss-making hotel units to franchisees under the agreement, and he received the franchisee fee. Here, the question before the High Court was whether the franchisee fee would be PGBP or IFHB. Now, this case was little different. Here, if you see, the assessee, while leasing the hotel, said to the franchisee that these franchisee would promote the tourism business of the assessee, would build the brand name of the assessee, and therefore in this particular case, here some conditions were imposed to the franchisees while leasing them these hotel units. So in this case, the High Court noted that here the business of the assessee was tourism, and he continued to operate the tourism business through franchisee. Therefore, the income received, the franchisee's fee, which was received, was for giving the right or privilege to the franchisees to undertake the business in property, right? Was given to and do the business under the property, and therefore here the income was taxable under the head business profession, because here the assessee leased the hotels in guise of earning the franchisee fees, and which were mainly for the purpose of enhancing his tourism business also, and therefore in this case it will be considered as income from business or profession. Clear? And not the income from house property, because here the assessee was doing business. Next case, again this is one very important case, Supreme Court case, in the case of Raj Dadarkar and Associates. Here the assessee had acquired a right to conduct a market on land obtained from BMC. He was having the possession of land for more than 12 years. He constructed some shops on that land and subletted the shops and stalls to other people. Now the question was whether the subletting income would be PGBP or IFHP. Again, the Supreme Court noted in this case that the assessee became deemed owner because he was having the ownership of the land or the possession of the land for more than 12 years. But in this particular case, Supreme Court distinguished the case of Chennai properties. Supreme Court distinguished the case of the Chennai properties, which we saw now. Here, the Supreme Court had seen that the objective was to let out the properties. But in Raj Dadarkar case, that was not clearly evident from the objective under the partnership deed. And in the Chennai properties case, the entire income was from only letting out of properties. But here it was not clear whether the entire income was from subletting the shops and stall. So therefore, in that case, Supreme Court said that here the assessee could not substantiate that the principal activity was only to do the business of letting out of properties, and therefore it should be taxable under the head income from house property. Clear? Is it clear? Any doubts? Any doubt? Any questions? Okay, so if there are no further questions, just tell me the answers of these questions then. Interest income on margin money deposited with bank for obtaining bank guarantee. Income from other sources or PGBP. So there is margin money deposited with the bank for obtaining bank guarantee. What it would be classified as? The interest on that would be income from other sources or PGBP. What do you think? What do you think? Whether interest on bank guarantees or the margin money which is deposited with bank for bank guarantees, business income or other sources. Quickly, please reply in the chat boxes quickly. Neha, other sources, why? The reason? Any other answers? Please quickly reply. Why, Sumit? I need more answers. Please reply quickly in your chat boxes. No, Neha. So, interest income on margin money deposited with the bank for obtaining bank guarantee will be PGBP. The reason for that is Section 56 says that the interest income shall be chargeable under the head income from other sources, specifically if it cannot be charged under the head PGBP. If it cannot be charged under the head PGBP. Now, this margin money is usually required to be kept with the banks. This is the requirement if you have any account or if you have to obtain the bank guarantee. So, bank guarantees are usually obtained for doing businesses, okay, for doing exports. So, bank guarantees are obtained for the purpose of business. If you have obtained that bank guarantee, you have to keep some margin money. So, you have kept this margin money on account of business expediency and not on account of any investment decision. This is not your investment decision to keep margin money, but it is a necessity to keep margin money. So if you have earned any interest out of that, because this margin money was kept for doing your business, for obtaining bank guarantee, this interest will also be treated as business income and not income from other sources. Clear? This will be treated as PGBP and not income from other sources. Clear? Next question. During the factory lockdown, management decided to let out the plant and machinery pending negotiation with workers. It received higher charges, whether it will be EFOS or PGBP. So there was a factory lockdown. The management during that lockdown let out the plant and machinery, whether it will be EFOS or PGBP. What do you think? Whether PGBP or EFOS, higher charges which are received. Quickly in your chat boxes, and I need more answers from more people. No, Sumit. Yes. Okay, okay. Yes, Ambika. Yes, perfect, Neha. So here if you see, the negotiations which were pending during that period, during the lockdown, what they did was they let out the plant and machinery. Again, it was not an investment decision or it was not a something casual income. This was done to reduce the loss due to temporary interruption of work at the factory site. So this was on account of business expediency and therefore this will be PGBP and not income from other sources. Is it clear? So 56 section says that the higher charges on let out of plant and machinery shall be chargeable under the head EFOS if it cannot be charged under the head PGBP. But in this case, this is on account of a business motive to earn the profits to offset the loss on account of lockdown. And therefore, this will be considered as PGBP and not income from other sources. Clear? Is it clear? Third question. Assessee owned a huge land and unable to dispose it off, he sold it in small pieces as per the buyer's requirement. So whether this will be capital gain or PGBP, what do you think? Assessee owned huge land and he was not able to dispose it off, so he sold it in small pieces as per the buyer's requirement. Whether PGBP or capital gain? Yes, Ambika, perfect. Fourth also correct, Ambika. What are the other answers? What do you think, capital gain or PGBP? Yes, Sumit, perfect. Why, Kunal? It depends. You cannot write the answer. It depends. That's very diplomatic answer, Kunal. What do you think? Capital gains or PGBP? So in this case, if you see, the business of assessee was not to sell the land. Since he was unable to sell it, he systematically, what he did was he sold it in small pieces, right? It was not his business to sell the land. So in this particular case, this would be considered as capital gains and not business income, because it cannot be said that the assessee was engaged in a systematic activity. Because he was unable to sell the huge plot of land, he decided to sell as per the buyer's requirement. And there was no plan to do that, right? He did that because he was unable to sell it. So there was no adventure in the nature of trade, commerce, or manufacture, right? Because the term business implies doing any activity systematically, applying skill, labor, and other sources with the objective of earning profit. That is the definition of business, right? Here you are not applying any skill. Here you are just doing it because you are unable to do that. So it's not adventure in the nature of trade or commerce or manufacture. Clear? Is it clear? Last, liquidated damages from supply of machinery. This we had done. Liquidated damages are capital in nature because they are the compensation for sterilization of profit-making apparatus. What is it? These are the liquidated damages are compensation towards sterilization of profit making apparatus. What does this mean? That your plant and machinery are the profit making apparatus. And since a damage is caused to that and a compensation is received against that, that is towards the sterilization of profit-making apparatus. So that cannot be considered to be revenue in nature. That is something in the nature of capital income, right? It is not something which is revenue in nature. So liquidated damages received for sterilization of profit-making apparatus will be considered as capital in nature. Is it clear? Any doubts? Any doubts with respect to this? Yes, Ambika, you're right. Saurashtra Cement case law it is. So, are there any doubts, or we can stop for today then if there are no further doubts? So, if there are no further doubts, we can stop today, and I'll again see you in the capital gain classes. So, thank you so much.